Hey guys, I'm back again with week 3 of the bootcamp, and this week we're really having a good long hard look at correlations. So what correlations are basically the relationships between different markets. So on some level all markets are correlated, but it goes without saying that some are going to be more highly correlated than others. I guess a really good example of that would be bonds with different durations, because they're all really trading for the same reasons. They're all based on the same sort of fundamentals. They just literally have a different duration. Probably an easier one to understand would be maybe commodity markets. So if we had wheat and soybeans and corn, they're all going to be driven by the same kind of things, which is by and large the weather. So you'd expect them always to move in the same direction and really in the same kind of style. So with that said, we can use that information to help give us better entries and exits with our markets. So there's really only two ways I like to think about using correlations. So if we have our chosen market, in this instance, it's the ZN that we're looking to trade. And this is the ZB, that's a 30-year bond, and this is the ZT, which is the 2-year bond. So there's only two times when I really want to be trading, and that's when all these markets are headed in the same direction. That's the first time, because that's kind of like the wave is going to the upside. All these markets are strong. I want to be trading to the upside. I want to be only getting long. To me, it's a bit like if you're going to the beach and you can be surfing a wave and catching it into shore, or you can be trying to paddle out and fight the waves coming back in. You really want to be going with where the strength is, where the waves are going, and you want to be using that power to kind of ride that strength. And if everything's pointing up, then that's kind of where you need to be looking to trade. You don't want to be kind of fighting that at all. The second type of trade that we can use correlations is when our market is the one that's kind of out of sync. So let's say the ZN is trading right down the bottom of its range, whilst the ZB and the ZT are at the top. Well, that's saying that for whatever reason at this point in time, the ZN is a little bit out of sync with the other two. When we're talking about bonds, often the short end of the yield curve, in this case the 2-year, really kind of dictates the way in which the market trades. So if the ZT is pointing up, that's kind of like the real rudder on a boat. Is it the rudder, the thing that gives it the direction? Anyway, hopefully you know what I mean. This is the one that kind of dictates the direction. So if the ZT is up and the ZB is also sort of up, and this market here is showing a bit of weakness, well, that tells me that there's going to be an opportunity for us to get long the ZN and hopefully let us ride that back in a few ticks where the ZN is back in line. Like I said, markets can get out of line for any number of reasons, and in the short term, it's usually just the fact that someone's been buying or selling. So maybe there had been a big seller in the ZN, he just sold this market down and pushed it down a few ticks, and there's a fairly good chance that market's going to spring back into line, and we're going to be able to make a few ticks out of that and risk very little in the process. In effect, that's kind of what spread trading is. So they're the two ways in which we can use that information to our advantage. So for this week's exercises in the bootcamp, I want you to sort of continue what you've already been doing. Use your traditional order flow and spotting these big buyers and sellers. And on top of that, we've added in our market profile areas. So what would happen now if we can also add in the correlation? So if the markets are all pointing up, maybe we're only looking at trades that are in the long direction, so to buy. And similarly, if maybe our market's the one that's out of sync, then in that instance, we're trying to sort of go long again. So in the same example, if the ZN was weak and these other two are strong, well, the overwhelming trend is still to the upside, so we're still only trying to look long in this instance. So it's another sort of layer that we can add to our trading. So a good example might be here, if the market is traded down to this level here, 124.06 half, and this market is really strong, this market's really strong, and we see some size printing into this bid here, and we see a bit of a ledge that's been established. Well, we know that there's going to be a pretty good chance this market's going to rebound and drift back up into the middle of this range, and it's going to make us a pretty low risk couple of ticks, because we're going with the momentum, we're going with the strength. So this is the exercise I want you to do this week. A lot of these are more kind of observational exercises. I just want you to sort of start taking some mental notes in your own head. If you're tracking your trades, in an Excel spreadsheet, that's also a pretty good idea. And just start getting used to seeing all these markets and what they're doing. Like I said before, don't get too caught up in the particulars. I don't really want you to be studying the depth of market from this one and the depth of market from this market as well. It's really too confusing at this stage. Just stick with focusing on the bids and the offers of your particular chosen market, and use these as really just a bit like a compass, I guess. So either the markets are up, they're down, or they're in the middle of the range, and that's going to be our guide. So we really want to pick the direction from what the other two markets are doing, and we'll go with it from there. So if you're trading bonds, definitely get the ZN, the ZB, and the ZT up. If you're in Europe, you can get the Euro stocks. If you're into equities, so you have the Euro stocks and the DAX together. If you're in the US and you want equities, you can get the ES and you can get the Dow Mini. So, like I said, try and find markets that are clearly correlated. If you're trading other products, you can think about markets that are clearly correlated, but I'd probably suggest you start off with the bonds because they're the easiest to get going with, and just go from there and just sort of see what observations you make yourself and see if that can add that real extra layer and improve the probability of your trade even further and push that edge even further. So that's ultimately what we're trying to achieve here. So good luck with the exercises this week. There's obviously more details in the blog posts, but stick with it, and if you have any problems at all, please don't hesitate to get in touch.